Where is the top for Bitcoin during this cycle? The answer is nobody knows. But there are some approaches that can give us good hints at what point in time Bitcoin might be comparatively expensive and when might it be relatively cheap. Now, it is uncertain whether or not those models will still work in the future. They might have worked in the past, but in the future they might break, right? All those predictions might not become true. So we have to figure out how can we potentially adjust for that uncertainty. We're going to talk about this in this video as well. Now let's have a look at a few approaches and I will share my thoughts about them as well. You've probably seen this before. This is the Bitcoin rainbow chart. So it gives us some kind of a trading range of Bitcoin. This is a long-term chart. It starts in 2010. And when we are close to the red area, we should rather sell. When we are close to the blue area, we should rather buy. And currently we are still in the blue-greenish area. Now here's the first problem I have with this approach. The issue is that at the beginning, the price tended to overshoot. It then hit the red area and then didn't reach it. In other words, the slope of this trend line tends to be too steep. If we were to start this higher and we were to connect the tops properly, then our upper target would be much lower than the $800,000, $900,000 in Bitcoin. Here's a slightly adjusted version of a similar approach. So that's the Bitcoin power law. And here the upper range for a potential cycle top is 500K or so. But again, we did not reach that in March of 2021. And we did see a more than 70% decline here, right? This was from almost 70K all the way to 16K. And so we can also do this a bit differently. How about we just forget about all of this financial mumbo jumbo? How about we don't do any regression analysis, but instead we just draw a curved line and connect those tops. I've showed this in prior videos as well. So there's nothing scientific about this, right? We just have a curved line here. And interestingly enough, those price tops, they all align very well as if there was a magic hand with that curved line. And according to that curved line, we are not far away at all from the cycle top. So the range goes from 900K to we've already reached the top. Now, I believe there's a good chance that we will actually break that long-term trend. And the reason is this chart here. It's the stablecoin dominance. How much of all of crypto is currently in the stablecoins? And there's an inverse correlation between the stablecoin dominance and the Bitcoin price. So when the stablecoin dominance is high, the Bitcoin price is low. When the stablecoin dominance is low, the Bitcoin price is high. So there's stablecoin deployments happening when this is going down, thus risk on prices go up. And there's still some more way for this to go down or for stablecoins to get more deployed. Thus, there is more way for the Bitcoin price to go up. Thus, I believe we will break this resistance at one point, despite this chart looking very much concerning. But let's step away a bit. We can try to take a somewhat advanced approach because the nice thing about the blockchain is we know who's buying, who's selling. We have more data than just the price data. Now what we've got over here is the top cap model. It's the average price over Bitcoin's existence times 36. Now this is not yet on-chain, but we're going to look at on-chain models in a second. Now according to this model, again, we would top out at around 500K. Very similar to what the power law is suggesting. But here is again why I believe this is an overestimation. In the early days, the price hit that top cap and still pushed higher. So this was an increase from $8 all the way to $29. So almost a 4x. Then for the subsequent three peaks, we did see a nice alignment. But then again, in 2021, we would have missed selling. We would have waited for another 2x in the Bitcoin price, which never happened. And so I believe this is again overestimating how much is possible. Now, here's a slightly more pessimistic, or should I say more realistic approach. This looks at the realized price relative to the average price during Bitcoin's history. So what was the price in general, but also what was the average cost basis of the market? And again, the issue is that in the early days, this tended to trigger very, very often when it was not a great time to sell, to then afterwards not trigger at all anymore. So it seems like as the volatility of Bitcoin is going down, as the relative growth of Bitcoin can't keep up anymore with the early days just because of the market cap, we're not going to see that delta top anymore. We also would have missed the 2021 top. And again, the whole idea of trading the cycles is to avoid those 70% declines. The delta top now gives us a price of 220K. So if we think that this is also overestimating the upside, then probably the cycle peak is below that. Now here we've got the terminal price. And this is potentially the most realistic of the models. This looks at the coin days destroyed. So what happens to the dormant Bitcoin? When a lot of coin days get destroyed, when the long-term holders are selling, it might make sense to sell as well. And yes, again, the problem is that in the early days, this tended to trigger a bit too early. But at least it also triggered in 2021. We would have taken some profit at around 60K. And so yes, since we overshoot less and less with every cycle, this time we might again not hit the terminal price, because ideally with models like this, we want to see exactly how it always touches the top, right? But here we see how the overshooting was strong at the beginning and less as time moved on. So maybe we have to sell before we hit that terminal price. And right now that's at $217,000. Now I'm personally going to at least short-term sell at around 130, 140K. I've shared this before on this channel, right? It's because of the stablecoin deployment, but that's rather a short-term move. If from 130 we then go back down maybe to 100K, I might buy back in again to then maybe sell later on, and potentially we could go to 200K. Who knows? Nobody has a crystal ball. We have to make our guesses. We have to put our money somewhere. And if we want to time the market to a degree, if we don't want to fall victim for 70 or 80% drops, we have to make a call sometimes. Now I said at the beginning of this video, since none of those models are perfect, we have to adjust for that uncertainty. And here's a potential way to do this. So have a look at an indicator like this, the CBBI. Now this combines a lot of different long-term Bitcoin price models. So the net unrealized profit and loss, the realized hodl ratio, so how much active trading is there, the Puel multiple, looking at the momentum, 2-year moving average, also a momentum indicator, the market value to realized value Z-score, so how much is the market currently in profit or loss relative to volatility, etc. So there are a few indicators that are all meshed up into one thing. And interestingly enough, this did peak and bottom very nicely with the cycle extremes. And so here's a potential solution to this uncertainty. We want to be more exposed to Bitcoin when this indicator is low. We want to be less exposed to Bitcoin when the indicator is high. But we can also get a bit more fancy than that. And I've made some insane drawings here. Look at my art. The y-axis is the CBBI value, and the x-axis is how much we are exposed to crypto or to Bitcoin. When the CBBI is very low, we want to be highly exposed. When the CBBI is very high, we want to be very little exposed. So this would just be a linear allocation. Now, since this is going from 0 to 100, the idea would be to only own half of the target allocation when we are at 50, to be pretty much 100% exposed when we are at 0, and to have pretty much zero exposure when we are at 100, right? So we want to sell everything at the cycle peak. We want to buy everything at the cycle bottom. So just a linear adjustment. And so as we go along, we sell high, we buy low again, we sell high. We might do this adjustment once a month, every 2 months, depending also on transaction costs. So that's a straightforward way to deal with this, right? We are always long, so that's why this is green. This horizontal line here in the middle, that just shows a 50 value in the CBBI. So when we are completely neutral in the market. And so we could go a bit more extreme, right? We could short Bitcoin whenever we are above 50. We don't short a lot when we are still close to 50, but as we go closer and closer to 100, we bet more and more on falling prices, because then the market is not in balance, right? It's overheated. And so we bet more and more on those falling prices until we retrace again to an equilibrium. And the same is true then, of course, when we go below the 50 mark, we linearly adjust more and more long exposure. We want to buy more and more BTC. Now we can even go a bit more extreme, and that's then here on the right with curvature. We do very little in the middle, and we only act upon Bitcoin when it's at the extreme levels. And then we go extreme short or extreme long. We can of course forget about the extreme short situation as well. We can only go extreme long. We can forget about crypto as a whole whenever the CBBI is above 50, but we allocate progressively more, not just linearly more, as we go closer to the bottom. So we would have a little bit exposure over here, a little bit over here, but then after a crash like this, we buy massively. We might even take out a personal loan to buy, right? We might do all kinds of things, sell our cars, sell our house, sell our grandmother, and buy Bitcoin with it. That is what is meant with this progressive allocation. And so all I'm saying over here is that despite nobody knowing where the exact top and bottom is, and despite those models sometimes failing, we can still make money in this market. Sometimes it does become clear that the market is extremely heated, right? When our taxi driver talks about Bitcoin, it's probably time to sell. And sometimes nobody wants to hear about Bitcoin. People might even declare you stupid buying after we have crashed 60, 70, 80%. Nobody wants to know about it. And that's then the time to get in heavily. And so the macro is much more important than the micro. It's simply important to understand, are we now as per tendency rather expensive or rather cheap? Does it make sense to rather buy or rather sell? And with that, we can ride the waves and we take profit along the way. And even if we don't hit the 500K or the 900K, that is fine because we locked in more and more profits as we rose up, and we then bought more and more as we crashed from the all-time high. Now here's something very important to understand. Crypto is highly correlated, as in when the market tends to go down, everything goes down at the same time. There's very little variation. This is true for the bear case, but it's also true for the bull case, as in most things go up at the same time. There seems to be not so much benefit in diversification, as in it seems to not really matter what kind of token we buy. If we have 5 tokens or we've got 20 tokens, the portfolio tends to move in the same direction anyway. Now the reason for those synchronized ups and downs in the market cannot just be money flows, because the money is flowing in and out of the overall space relatively consistently with little volatility. What we've got over here is the stablecoin market cap. And since October of 2023, we tend to go up over time. So there is money getting into the system. People deposit their fiat currency, say on a centralized exchange. The centralized exchange then sends it over to a stablecoin custodian. The custodian holds the funds in a bank account and then mints the stablecoins on the chain. And we can see that minting, but also the redemption on this chart. So the volatility that all prices go up or all prices go down, it's not caused by money flowing in and out of the system as a whole. Instead, I believe it's caused by the swapping activity. So people going risk on or going risk off. So it's not the market as a whole expanding or contracting, it's the participants within the market that swap. And we can see that swapping activity with much more volatility here. So this is now the stablecoin dominance. We're not looking at the stablecoin market cap, we're looking at the stablecoin dominance. How much of all of crypto is in stables? And in the last 1.5 years, this tended to move in a range between 9% and 5%. And now compare that stablecoin dominance with the Bitcoin price. When the stablecoin dominance is low, it means the Bitcoin price tends to be high. When the stablecoin dominance is high, it means the Bitcoin price tends to be low. So there is somewhat of an inverse correlation. When people deploy their stablecoins, or when they're swapping from risk off to risk on, when stablecoin dominance goes down, prices tend to go up. And so because of that overall effect of market synchronization, because of the high correlation, things move in the same direction at the same time, it's not a good idea to just look at US dollar prices in order to make a good decision whether or not to buy or sell an altcoin. Because charts like this are also influenced by the overall market swapping activity, not just by the swapping activity within the altcoin. So for example, this here, right? This is Dogecoin. And who would have thought that Dogecoin already peaks at 46 cents when in the past it peaked at 56, 57 cents? Who would have already anticipated the peak earlier? How could we figure that out? Here is how we can figure that out. This is Dogecoin's dominance. And here those two tops align very nicely. And so a dominance chart is simply a chart that looks at the current market cap of an altcoin relative to all of crypto. So that way we remove the ups and downs of Bitcoin or of Ethereum. We're just looking at the relative performance of the altcoin versus the rest of the market. And again, that tends to trade in ranges. And that's how we can find out how the second peak should actually happen earlier in US dollars, because the dominance was already at historical heights. But check out this, right? This is Shiba Inu in US dollars. But here's Shiba Inu's dominance. So we do have a quiet, constant trend Over time, Shiba Inu tends to underperform the rest of the market, and when we are high on the trading range, it might make sense to bet on falling prices. When we are low, we could potentially buy, but of course it's always somewhat risky to buy low when the overall trend is also bearish. So I personally prefer, when there's a declining trend, to look for short opportunities, so to bet on falling prices when we are high, and when we are in an upwards trend, to buy the dips. So when we're in a bull market, we buy the dips. When we're in a bear market, we short the top. And so Shiba Inu underperforms the market over the long term. So instead of trying to fish for bottoms here, isn't it better to just wait for the next short squeeze, to wait for the next rally in the price, to then bet on falling prices? Then the time is also on our side. Even if we see a bit of a spike above the regular trading range, we can just wait it out, because the overall trend is in our favor. That's not necessarily true when we buy, right? When we buy low in a declining trend, we might not find the exit on time and then have to sell again, potentially lower. Another example, here's Chainlink. And what we see over here, that's Chainlink's dominance. So just according to this chart, it might make sense to potentially buy some Link over just Bitcoin or Ethereum. Historically, it's rather cheap. Now, there are two central reasons why I like those relative valuation charts and those dominance charts. The first one is that we can actually see what happens specifically with that token, completely independent of the overall market. But the second reason is by plotting relative valuation charts, so say cryptocurrency A versus cryptocurrency B, we tend to see less volatility. We tend to see the trends clearer. For example, over here, this is the Ethereum price in US dollars since February of 2021. There's no clear trend. It's not necessarily easy to figure out when to buy or when to sell. But then we've got here Ethereum relative to Balancer. I like to look at this chart because it gives us two nice points. First of all, the overall volatility is rather small, but secondly, the gains are also extremely consistent. So this is an outperformance of 5,400%. This is how much Ethereum outperformed Balancer. And again, relatively speaking, with not that much volatility. Getting that much performance in a such consistent manner without having to time the market actively, that's quite unique, right? This is a risk to reward that we can only get with relative valuation plays. We can't get this just by buying something in US dollars. And again, the reason why everything in US dollars fluctuates so much is because the market as a whole goes risk on and risk off all the time. And that creates massive additional volatility. But we can get rid of that volatility. We can actually make money by buying this. Now, we don't just buy this, we have to set up a long Ethereum and a short Balancer position. So to get this performance, we have to do a bit of quote unquote financial trickery. But yeah, why do we see such consistent outperformance? The reason is that Balancer over time tends to have an expanding token supply. And a lot of that additional supply goes to liquidity mining. So to a lot of people that just get continued allocation to the token that then sell it off over time. And so this then differentiates the winners from the losers long term. The people that are willing to take one step further, they're going to look not just at the next 100x meme coin, it's likely going to go to zero, but that actually figure out what are the dynamics within the market and how can we profit from those dynamics. Those people tend to do better than just the people that buy and hold Bitcoin, for example. I have made dedicated tutorial videos on the topic. First of all, how do we even plot those relative valuation charts? How can we look at them? There's an entire tutorial section just on how to use TradingView in a proper manner and seeing the things that most people don't, right? Most people just look at things like this. This is not giving us any edge. But then there are also videos on how to actually execute those trades. How can we gain from relative valuations? How can we set this up? How can we continually make money with comparatively little risk? Now, most people here on YouTube are not willing to share their own performance, but I'm okay with doing that. I'm okay to share how much money I'm making on average over buying and holding Bitcoin. Because this is again where the big differentiator is. Everybody can get Bitcoin's performance, but actually the art in this is to make more than Bitcoin. If we take the time to trade actively, we have to outperform the benchmark. Now here are the monthly returns that I have made over buying and holding Bitcoin. So every data point is a month. This dotted line here is the 12-month moving average. And when we average out all of those dots, the monthly alpha over buying and holding Bitcoin for me is 2.1%. Now that might not sound like much, but that compounds over time. And then especially if we also add more money in the portfolio over time, we dollar cost average in, we have a quite nice smooth growth curve. So here's my active portfolio with trading and dollar cost averaging. And I hope that over the next 2 to 2.5 years, I'll be able again to double that portfolio. If we of course use leverage, we can make much more on a single trade. But I'm super cautious. I take very small bets. For example, have a look at this. I'm sharing my own trades. This is in the Gerhard Trade channel, and I opened again, based on relative valuations, a short of the Donald Trump meme coin. Trump relative to Solana was quite high, and it started to come down. And then our members also entered. They also had some leverage in there, so this was some gains. I waited a bit longer, closed this then at 141%. But because I only use 1 or 2% of my entire portfolio on a trade like this, the average alpha per month is only 2.1%. But if you're willing to take on more risk, you can of course grow much faster. Actually, our members do exactly that. So here's the channel, share your wins with some leverage and proper market timing and still reasonable risk management. There are several 100% in single trades easily possible. And so I think it's very important to forget about price targets, as in can Ethereum hit $4,000 or can Dogecoin hit $1, etc. Those kind of things don't really matter. What really matters is the relative performance. Capital within crypto moves from asset to asset. Attention moves from asset to asset. So there is all of the capital in the space. Sometimes it is risk on, sometimes it is risk off. But what really matters is where is the capital flowing to and where is it going away. And then all we need to do is to trade the relative valuation. It's much easier to make money that way. Again, would you rather hold this or would you rather hold this? And so yeah, feel free to check it out. It's currently $125 per month. You are locking in that rate. So when we come back to the 165 again in a few months, then you will still continue paying the 125. Whatever you're paying now, you will continue to pay. I will not increase the rate for everybody that's signing up now. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. There should be also somewhere a pop-up here on the right where you can click directly. It will lead you to the website. So see you over there. Cheers.